So you want to buy your dream home, at least you want to buy your first residential home. Now in this video we're going to talk about what it's going to take for you to buy your first home, what are the barriers to entry and all the things that you need to prepare for so you can do this as soon as possible. Welcome to Ticks and Measures, where we try to turn our hindsight to your foresight. You know, over here trying to bridge the gap that school's been leaving and hopefully educating you in the things that life will eventually have to teach you by fire by force, but here is by mercy. So today we're going to be talking about what it goes into buying a house and how you can buy your residential home as soon as possible. Ultimately, within the UK, typically when people come to buying their first property, it takes them anywhere between 6 to 20 years to save up enough for them to actually buy their home. In this, we're going to talk about how you can do it essentially within 5 years, depending on where you're looking at, but as soon as possible is basically what we're saying. Now, ultimately, the earlier you start getting ready on all these aspects will determine how long it will take for you to buy a home. Because I've seen out there that there's a lot of misconceptions about buying a home. People just think that, okay, I come out, I make some money, and then I'm going to have enough money to buy a home, but you've not put it in perspective. So today we're going to put it in perspective for you and let you understand what you need to know. Again, if you have any questions about anything that we say in here, drop it into the comments, ask us any questions. We'll be making a follow-up and in more detail than this video. Obviously, there's only so much we can cover in order to not bore you. So hit the like button, subscribe if you're new, and thank you. Now straight into it. Now, in order for you to get your first residential home, there are essentially 3 barriers to entry. Generally, there's a couple things here there, but we're going to talk about the 3 barriers to entry. And they are 1, credit, 2, deposit, 3, affordability. Now in each of these sections we're going to be talking about things within this, and then you see the timestamps if you want to skip over. 1, credit. Now in order to, for majority of people, you are trying to obtain a house via a mortgage. So if you didn't, you wouldn't necessarily be on here, but you are trying to attain it via a mortgage. Now, as it's your own residential property, it's going to come down to your personal situation, to whether they will even allow you to even apply for a mortgage. And that comes down to your credit rating. Now, credit rating / your credit report / your credit score are all indications and all represent your financial CV towards banks, whether they're going to lend you money. Now, you need to make sure that your credit score is as high as it can possibly be. Now, things in order to do this: if you don't have a credit card, get a credit card. If you have a credit card, don't leave a balance. Make sure every month you pay at least the minimum balance plus 10% always, and never try your best, never carry a balance. That's how you use a credit card efficiently. A credit card is one of the best ways to build your credit score because it's revolving debt. It's something that you can continue having onwards. Your phone contract and everything, your other stuff is good in terms of adding the 5% for your credit mix, but they are always two-year contracts. They're not continuous enough. It's not something you can have for the rest of your life to build your credit on. And some lenders actually don't look at your phone bill and your other things and your rent and all those things to establish your credit score. They look at whether maybe you have an overdraft, or if you maybe not even your overdraft, but mainly whether you've taken any loans, whether you've taken any whether you have any credit cards. And that's the reason why people who've taken a mortgage are more successful in getting a second mortgage, because that's the kind of debt that they're looking at more so when they look at your credit report. Now, when it comes to your credit, when you now prepare and get ready to buy a home, 1, never open any kind of credit product within 8 months of you looking to apply for a mortgage. Now, people say 6 months, but the reason why I say 8 months is because whenever you take out a new product, it can take up to 2 months for that to actually show up in your credit report. And when it comes up to your credit report, it will flag for those 6 months. So when I say any credit product, that means no renewing your car insurance monthly. You can do it a whole year one. Don't do monthly renewal of your car insurance within 8 months of buying a house. Don't take out a new phone contract before doing that. Don't go and buy a new car on finance within 8 months of wanting to apply for a mortgage. Don't do any of these things, because these will mess up your credit rating, and they will look at it as you're now borrowing too much money, and that will affect your affordability when it comes to you buying a home. Now, on to the second one. Now we finished that section about credit. Now understand your credit is a whole big thing. We just skimmed over it and we have other videos explaining it. Now we're going to go straight into number 2. 2, deposit. Now this is where everyone feels that is going to be the hardest thing for them to actually achieve, which is their deposit. Now the deposit obviously is the sum of money you're going to need to buy a house. Now the first thing you need to know is, where do you kind of want to buy? Where do you want to kind of live? What kind of property do you want to have? Is it a 2-bed, a 3-bed? Is it a house or a flat? Is it going to be help to buy? Is it going to be shared ownership? All of these different things is going to be what will determine how much a deposit you will need. Now, most first-time buyers aim to get 5%, but as you can see, when the pandemic came in last year, the mortgage lenders scrapped 5% like as quickly as possible. They even scrapped 10%, and only now, as I'm recording this video, is 10% now come back to market. Optimal now is 15%, but historically, the average of the last few years of the deposit that most first-time buyers actually put down is 16%. Now, for you to start saving this, if you want to buy a home, it typically takes up to 6 years or so for you to be incrementally saving towards that. Now, once you know how much you need to save, then you can now put in a budget for you to now save that. So in order to, get there, you're not going to save it all in one lump sum. So if it's now 10K, break it up into per year. Even if you're in uni, all those kind of things, start by putting away 10%, then 20%, continue increasing your saving rates, and then dividing that up into just saving for saving's sake and saving for house. Obviously, a lot of people I know that have been able to now secure their home now have been saving since uni. For the last 3-4 years, 5 years, they've been saving. Now, if your income continues to increase, you need to continue increasing your savings. And when I look at your deposit, there's two things you want to look at your deposit. The 5-10% that you're looking for, aim for 10%. That's what you should be aiming to save. We don't know where the economy is going, so we're not sure if 5% products will be coming back. And if you do get 5%, it may likely be it may likely be terrible interest rates, which we'll get to in another video. So aim for at least 10% to be saved for you to buy a home. But that is only one part of you buying a home. So whatever you're saving for, whatever that 10% is that you're saving for the house, then add an extra 5% on top of that, in terms of just half of what your deposit is on top of that, to pay for conveyancing fees, for lawyer fees, solicitors fees, money to close the contracts for your mortgage broker, for doing inspections, doing building structural inspections, all those things. There's loads of random fees in there, the product fees from you can include this in your mortgage and everything. There's loads of different things that you can do, but you want to leave an extra. So if you're saving 10K for the deposit, then as let's say it's 10%, it's 100K house or 100K flat, and that's 10K, then say 10K, but then you save at least 5K for all the closing fees. Typically there will be about between 5 to 7K around that, and then you also want to consider how much you might need to save in terms of moving in costs, any of those kind of things. So when you look at a deposit in terms of buying a house, don't just look at the deposits of, this is just a deposit, I've made it 10%, now I can buy a house. No, it's 10% plus all the closing costs and everything, and then on top of that, for your own peace of mind, how much money will you actually need on top of that to move in. So when it comes to the deposit, in order to maximize it, you need to know what products are out there for you to be able to maximize your savings, because ultimately you don't want just your savings sitting there, because you have your savings there for at least a year, 2 years, 3 years, 4 years, 5 years. So you need your savings to grow. So it's good for you to take advantage of very good savings accounts with the highest interest rates that are available at the time of writing or the time of watching, or high interest current accounts where if you leave the balance in there, it grows. You also want to, if for those who did it on time, I've taken advantage of the Help to Buy ISA and continue contributing there. They have very high interest rates there. And also for a lot of you, you may also want to consider the lifetime ISA. So take advantage of all these things. Also, you can now look in terms of how to maximize your deposit by looking at things like shared ownership, Help to Buy loan, Help to Buy equity loan, and what's coming new, which is the first home scheme, which will be coming out newly, which will be a discount on the home prices itself from 30%. So when those come around, we'll do a video on it and let you guys understand more. But understand, your deposit is just one part, and that is just the one part for you to actually get to be speaking to them in the first place. But that doesn't seal the deal. You need the money for the closing costs, you need the money for you to move in, and all those other stuff. Now, we've spoken about deposits and how that's the sum of money you need to start saving, etc. And then once you've established how much you need, you break that up and then you start saving from get-go. Save as much as you can with as little as you can, but it's the consistency of saving that actually helps you end up getting to where you want to be in terms of buying a home. So if you're in uni, if you can put £50 away per month, and then as you earn more money, you start making £100, and when you graduate, you now start making it £200, £300, then when you can go up, go to £400, and if you get a bonus, you increase it, and you progressively increase it. So it's not going to be linear, it's going to be exponential, and then that's how you get to where you want to get to faster, by you increasing it as life increases for you, or if you get any free money. Now we go into the third one, which is affordability. Now, in honest truth, these three things, you can actually see the way that I ranked it as credit, deposit, and affordability. Now, for most people, they think their biggest hurdle is going to be deposit, and that, you know, credit is like, you know, they can sort that out, and then what's it called, the affordability, people don't even think about that. But I've actually ranked this in order of the difficulty from least to highest. So, you know, the least difficulty is your credit. You can actually sort that out. You don't need to pay anybody. Just get a credit builder card, put £50 on it, and then pay it off before your due date comes in. This is not financial advice. Nothing in this video is financial advice. I'm not your financial advisor. So, but everything in here is, in my opinion, what I would do. The second hardest thing is your deposit. That's your saving. You can control that. You can now continue to save that. Now, the third thing, which is the hardest one for everybody, is your affordability. And now this is basically how much are you able to afford. Now, I'm going to use a breadstick to illustrate. Now, you have a breadstick here. Now, when we're talking about your deposit, you look at this as your home, how much your house is worth. Now, your deposit is this. Let's say that's 10% of this. So that means you actually own 10% of the house. That's equity. Equity means how much of the house is what you own in terms of what percentage of this house that you own, that if they were to sell, this is the value you'd get back. So you get 10%. And this remaining 90% is how much that you are borrowing from the bank. That is your mortgage. A mortgage is just basically a loan for a home. It's that simply what it is. Now, for you to be able to get this 90 from the bank, you need to be able to afford by this. And the amount of money that you may need to afford to this is that to afford a mortgage essentially is where the affordability comes into. Now you can reduce or increase the amount of money you need to afford to in terms of a mortgage by either increasing or decreasing your deposits. Now obviously if you increase your deposit to half, you need to afford half the mortgage. Now that's saying that in terms of your affordability, if you're working normal payee, then they will take 4 to 4.5 to 4, between 4 and 5 times your income. In rare cases, they may take 6 times your income within special things, and that's how much you actually need to make in order to afford. So when you're looking at a house, especially if you're in uni and you're progressing and you're going in your job, you need to kind of look at how much you're earning per year, and then see how much am I actually going to be able to afford based on how much you're making. So if you're making 40k, you know, or let's say typically you're making 30k, for example. If you're making 30k even in London, it doesn't matter where you are, you make 30k, then the likelihood is that on a mortgage you may only be able to afford on the lower scale of 4% or 4 times 120k, to on the high side 5, which is just about 150k, to the rare side of 180k. That makes sense, which is 6 times. So that's the scale that you're working on. Now this is where you need to look at in terms of your affordability. That's when you start looking at the schemes like the you know, shared ownership. Shared ownership cuts that in half. So instead of even if your house is worth 500k, then or let's say your house is worth 300k, and then it's a 50% share that you're going to buy, you only need to afford how much it is for that 50% share. The rest you're going to pay rent on. So that's why it's a good one, because it reduces what you need to afford, but you still end up paying what you would have needed to pay anyway on rent to the other side, to the housing association. At this juncture as well, this is when you want to start considering whether you are looking to buy this house by yourself. Now, if you want to be a sole owner of this home, it may be your affordability, then you know how much money you need to afford. So you need to afford 4 to 5 times, not the value of the home, the value of the side that you want to, the value of the house that you want to mortgage. So assuming I wanted to go for a 300k house and I had a 50k let's say deposit saved, then the money I need to earn just needs to be able to qualify for the 250k mortgage, which on that sense I need to be earning 50k in order to afford that, if that makes sense. But assuming I reduced it and I only had 10% on the 300k, then that's 30k, then that's 270. So I'd need to earn a bit more than 50k, probably like 52, 54, 55k in order for me to afford a mortgage on 270. So how much you have as your deposit will fluctuate on how much you're able to afford on a mortgage. Now, like I said, you want to consider whether you want to do it by yourself or you want to do it with your spouse, partner, your friend, or if you're saving and hoping that the person you meet is also saving, so that when it comes to in 5 years time, you guys can do it together. But ultimately, it's not easy for you to buy a house on your own. There was a there was a funny thing that someone did like last year, that you can earn the average salary in London and pay the average rent, but still will not be able to afford the average home. So most people have to do it with somebody else. That's the only reason. That's what's hard. Now you can use your friends, your brother, your sister, your spouse, your partner, girlfriend, boyfriend, depending. Some mortgage providers are only happy if you guys have the same surname, or if you guys are in a relationship, to go ahead with it. Understand, if you go into a mortgage, it is a contract. It is, so don't think that you, just because I trust this person, it's a different kettle of fish when business and money comes into the frame. Now, typically on a mortgage application, most lenders prefer to have two people on there, but I have seen in the past where maximum of 4 people have had their name on there, in order to increase the overall affordability of the home, so that for you to get it. Now obviously there's limitations within this, like for example, if you want to use your parents, depending on your parents' age, will will reduce the amount of time you can actually have the mortgage for. So if your parents are over 50, over 60, then typically mortgage lenders like to go up to about 70, 73, 80 max. So you that's going to be paying it, even if you bring your parents on there to increase the affordability, then you're going to only have a shorter amount of time to have the mortgage, and that will increase your mortgage payments. Now obviously remember, the lower deposit that you put in will affect the amount of interest you're probably going to get from them. So if you put a higher deposit, then you get more lenders happy to lend to you, and you also get a reduced interest. So affordability, is one of those ones you want to look out for, because they will take into other account, any allowances you're getting, any bonuses you're getting. That's the reason why, but ultimately, when you look at the affordability in terms of qualifying, the second thing you have to look about is the affordability for yourself, whether you can actually afford to pay it. Because similarly, like when I said with the deposit section, where people only look at the deposit, they don't look at the fact that they're going to have to pay a lawyer, solicitor, building inspection, building regulation, planning, if they want to do any planning stuff. A lot of money goes along the way and changes hands, which is about 4 to 5k. In terms of your own affordability, people look only specifically on the mortgage payment. Now, if you're going to own a home, you need to understand that you're not just going to only pay your mortgage payment. It's not the only thing that you pay. You're going to pay the mortgage, you're going to pay home insurance, you're going to pay council tax, you're going to pay utility bills, which is water, electricity, and gas. You also pay for internet, and then you also consider home improvements that will come, because none of your homes are designed to last forever. There'll be roof that needs to be changing. There's all those things. So you need to kind of think about how you're going to handle those costs on a day-to-day basis and affordability basis. And that also comes to how much are you planning to earn in the future, or how much you're earning now. How do you increase your salary, or are you going to do it with somebody else to make life easier for you? There's also ways to house hack in order for you to make your payments lower for yourself in the long run, but I'll speak about that in a future video. But at this juncture, listen, when it comes to this, it comes holistically. Budget, spend less, earn more, save more, and then depending on when you're trying to buy a home, invest. But don't invest all the money you're trying to buy for a home. Only invest in places where you understand, but make sure that you're looking for the good, the best interest rate accounts out there for you to grow your money, so that when it comes to you to buy a home, you are fully prepared and fully ready to execute. Now, I want to congratulate you for getting to the end of this video. I want to hopefully, help us, help you, help us, help you, help us, help you. Hit the like button. That was confusing, didn't make sense to me, but it is what it is. I hope this video brought value to you, and as you started your journey towards buying a home, it might seem like it's so far away, but time really flies very quickly. So I'm imploring you to start as quickly as possible in getting your things in order. Budget and say when you want to achieve these things, and then look at your current condition in terms of your salary, etc., and then just continue to grow. I understand that home ownership, I understand that for a lot of people, they think home ownership is the way to go and the only way for us to get to where we need to be, and that is a good driver of wealth and a good, general thing to increase your your net worth. But it can go up and go down. There's no shame in renting. and renting isn't actually a waste of your money. If you can see, as I've laid out here, just some of the cost and some of the work that goes into just buying a home and maintaining a home in terms of monthly sense, you can see that to some extent you may be actually getting a good deal by renting. So you want to buy a home when you're ready to buy a home, as opposed to rushing to buy a home and then have it to be the biggest regret that you make in your life. So in here, we try to turn our hindsight into your foresight. Hopefully it's helped. So share this with somebody. Thank you for making it to end. Congratulations on buying a new home, and let us know if this video helped you or if you think this is trash, because we all need to help each other grow. So have a blessed day. My name has been Hugo. This has been Teaks and Mentorship Scheme. Take care. Get your